Whatever you do, get rid of this fear of missing out, this terrible lust to participate in profit making that comes along at the end of every one of the great bubbles. It is incredibly seductive, very hard to resist. Been there, done that myself a few decades ago, made a fortune and wiped myself out. Very salutary. And I would wish on most of you that you avoid it. It's crossed off all the boxes. It's done all the things that a super bubble typically does, and it could start its way down anytime and perhaps a month ago. It needs a long bull market, and we had 11 years, so the longest in history. It needs a lot of crazy behavior, and we had some of the great crazy behavior of all time. I think they'll be telling these stories in 20 years. It needs to accelerate at the end of a bubble. It's something like 3 times the average rate of the bull market, and it did that. From COVID on upwards, the NASDAQ more than doubled, and it went up at well over 3 times the normal rate. And finally, a thing that is unique to the super bubbles, the 2 or 3 that just keep going and going, is that at the end, the speculative stocks start to peel off. And even on the upside, for the broad market, they start to go down. And that started early last year. The super duper specs, the worst of them all, started to decline. And then one by one, they fell in and started to drop. And as we sit today, something like 40% of all the NASDAQ stocks are down over 50%, which is pretty amazing since it's only the other day the S&P was at its all-time high in late December. Nothing is certain in life, but I would say that is the beginning of the burst when the specs that typically go up quite a lot more than the market go down as the market goes up. And a lot of the most speculative stocks of 2020 were already going down. That is very rare. It happened in 1929. It happened in 1972 before the very big decline then. It happened in 2000 before the tech wipeout.
So you're saying we are at the beginning of a crash?
I would say it is likely that we are. I think it would be unlikely that the market would not come down by 50% from its peak. The broad market, the S&P, and it would be unusual if the specs did not do worse than that. The problem is it slow or is it quick? The stimulus program left a lot of money in individual hands for buying the dip, and they have been throwing money this year, individuals, at the dips. They have probably never invested more rapidly than they have this year, and despite that, of course, the market is down. But they have a lot of money. They're pretty well funded. Corporations, many corporations are doing well. The economy isn't too bad. So this could turn out to be quite a struggle, where slowly but surely the market has to readjust to higher and higher rates and higher inflation. It will not give up, I suspect, too easily, but will fight it out. If you look at the real estate market, all real estate markets pretty well around the world are very, very high. And if you look at the bond market, of course, interest rates are incredibly low and bonds are incredibly high. But when it comes to the stock market, rather like 2000 and the tech bubble, this is more an American affair than anything else. Outside America, the world is merely overpriced. Ho-hum. It's often overpriced. It's usually not that dangerous.
Want to trade and invest in global markets with ease? Build your portfolio with a one-stop investment app. Moomoo offers access to stocks, ETFs, options, and more. Click the link in the description and make a deposit to claim your free stocks.
In the US, however, we have an extreme overpricing, extreme crazy behavior, and I think we're in a rather dangerous equity bubble. So there is a decent chance that Australia, the UK, Japan, there's some fairly reasonably priced countries. If they come down in sympathy, they'll come down a lot less and probably rally earlier. This bubble in the US is eerily similar to the 2000 tech bubble. It's led by the NASDAQ, it's led by the specs. 2000, the specs underperformed all year and the S&P continued to climb. It is just possible that the S&P will rally to a new high. I think it is impossible that the specs will. So I think the game has started, and it will play out perhaps rather like 2000. Historically, the stock market has hated inflation. It crushes price-earnings ratios. This time, uniquely, it did not. Inflation started June of last year, roared through the roof, and the PEs continued to rise. Nothing like that had happened before. And we have a model that goes back to 1925, and there are two factors that determine price-earnings ratios, or the price level of the market. One of them is profit margins. Of course, it loves them. And the other is inflation. Of course, it hates it. And they have worked like a charm. And in 2000, you had, for example, at the top of the market, world record profit margins and very little inflation. And today we have world record profit margins, but we have rather high inflation. The market should have dropped starting in the middle of last year had it been following the normal battle plan. It did not. The market is saying about inflation that it totally ignores it. It completely believes the Fed that it's temporary, ephemeral, etc. And it doesn't appear to be. And if that seeps into the market in the usual way, it will mercilessly depress the price-earnings ratios. And in the end, the Fed doesn't like to get on the bad side of the administration. Politically, inflation is death. The average person in the street notices it, measures it, if anything, exaggerates it. But even with that exaggeration, it's painful and politically very, very tough on the voting pattern. And therefore, the administration really wants to do everything it can to get inflation down. So it will be discreetly leaning on the Fed to do what it can. There are people who spend their entire lives watching the Fed and going into the nuances of quarter points and half points, and I do not. I am confident that they will move at the stronger end of the range. I am confident they will try very hard to make sure that inflation does not become embedded. I'm also confident that that will be difficult because we're very short of labor, we're running very scarce, and wage rates will start to come through the system in the US increasingly for the next few months. That makes it very difficult to control inflation. So it will be quite a struggle, and the Fed will have to raise the rates quite a bit. If you have to own US stocks, you should own high quality stocks that are in good financial shape, because this can always spiral in to something of a financial crisis. They often do. I would emphasize, in general though, non-US stocks. And quite a few countries, as I said, are not that bad. Emerging markets has some overhang problems. If the US goes and commodities are high priced, it's a mixed blessing at best for them, but they're very, very cheap. And in the end, cheapness usually trumps everything else. So emerging markets, some of the cheaper developed countries would be very much better idea than a massive holding of US equities. I think it is ending. I'm trying to write a paper which is basically the end of the golden era, or Goldilocks and three hungry bears. Everything has been different for the 20 years of the 21st century. The PEs average not just a little bit higher, but 50, 60% higher. Profit margins average 30, 35% higher than they had in the previous 50, 60 years. Everything seemed to work out. Corporations got a lot of political power. The taxes on capital all dropped. Tax on dividends, tax on interest rates, tax on capital gains all came down. Most of the regulatory bodies were somewhat captured by corporations, and they have had a golden era. We've never seen bigger profits. The concentration in each industry has increased, and the FANGs that are remarkable companies are in their own way instant monopolies. So the monopolistic feature of our economy today, and somewhat around the world, has increased. This is very good for profits. It's not so good for growth. And the governments are beginning to twitch a bit. I don't think they're assets. I think they embed a technology that may turn out rather like the internet to be useful here, there, and everywhere. And when they are useful and when they're making money in the traditional way, then you value it like any other money-making enterprise. But while they just sit there and they go up in price because people are persuaded that they will go up in price, it's very much a question of the emperor and his clothes, I think. Bitcoin in particular, it does nothing for anybody and is superseded by a whole generation of smarter and more effective cryptocurrencies, many of which in their turn do not make money in the traditional way, and a few do. So I'm sure the idea embedded in cryptocurrency will be around perhaps forever. But I'm equally certain that most of the value today as a store of value is a hoax. It is not a store of value. Everyone can agree that the volatility is massive. It goes up and down with the high-risk stocks. What is the point of a store of value that trades like a hyperspec? I mean, this is not the principle. Gold, in comparison, with several thousand years of practice, has been boringly stable throughout the last couple of years. I should know, I own some.
For me, value has always been you pay for what you get. So I'm not a great believer in price to book, particularly since book as an accounting entry has been incredibly distorted in the last 20 years. It used to be a pretty good proxy back in the 90s, 80s, 70s, but not recently. What I've always felt is the best definition of value is a dividend discount model that projects earnings into the future, discounts them back according to the quality, with high quality companies having a lower discount rate than junky companies. And what we brought to bear on this 40 years ago almost was we studied the regression rate by type of company. We tried to work out on a company specific basis what regression rate they were liable to have if they behaved in the normal way, given their special characteristics. And so we had Microsoft in our value portfolio all the way through the 90s. We didn't phase it out until June of 99. We started to slice it out. We had 12 monthly slices. And by June of 2000, really before the crunch came on Microsoft, we had gotten rid of it. And if you use those models, you do see, for example, that emerging markets are absolutely cheap. They are relatively as cheap as they have ever been, parallel to one or two other occasions, but if anything, a little bit even cheaper relatively. And you see that they are absolutely not bad at all. And that's the group where the absolute price looks appealing. And I can anticipate, because I hear it so often, of course, emerging markets always has a lot of question marks, a lot of risk questions, a lot of quality questions, a lot of currency questions, and so on and so forth. And it's all true. They've always had those things, but they are highly diversified. You've got, 28 countries in the index. 40% of that is China. And heck, China, the biggest economy in the world in inflation-adjusted dollars, considerably bigger than the US, growing much faster. Just this year alone, by the way, they've opened up yet another 10% GDP gap. We're -4 and they're +6. And they're grinding this out. The IMF, as you know, the rest of the guys think that they're going to have to carry about a third of all the growth on the planet on their shoulders. And then you have India, who until the recent virus was growing even faster than China, and on the cusp of becoming a giant economy, and interestingly into intellectual capital and consulting and the use of real brain power. And then you have interesting, riskier elements, Brazil and so on. It really is the future in a world where the developed world has had a growth rate that frankly is slowly but surely unraveling for 40 years. When I came here, the productivity per person hour was about 3% a year. And now it's down to 1. And they'll be lucky to be 1 in Europe. So growth is not what it was. And then the increase in the workforce has declined. When I got here, it was 1.5% a year. This year, it will be 0.2. In 10 years, the US will go negative. Japan has been negative in the growth rate of the workforce for 15 to 20 years. And Europe is going negative as we sit. We're going to have to get used to a GDP growth, which is a whole lot less than we thought. And there'll be a premium on growth. And emerging will have a lot higher top-line revenue than the developed world. We are suffering a baby bust without precedent throughout the world in the developed markets. South Korea is a whole lot worse than China at 1.0 fertility rate, when 2.1 is replacement. I mean, it's just hard to get one's brain around it. They're losing half the baby cohort every generation, which is to say every 30, 35 years. Italy is 1.4, Japan is 1.4. China is 1.5, 1.55, which is terrible. The US is 1.70. Italy's in the mix, and Hungary's, the growth rate of Europe in population is going to be very similar to China's, perhaps a little bit higher, but not enough to count. The US will not have a rising workforce. We were highly unlikely to take immigrants sufficient to block a drop-off in the baby cohort. At 1.7, you're running 15% plus below replacement. We haven't taken that level of immigrants for years. And we don't know going forward how the immigration numbers will hold up, but highly unlikely, I think, to expand enough to even get to zero. But the US will have a slower rate of decline in the workforce over the next 50 years than Europe and China, and of course, very much slower than the developed world. That becomes one of the more attractive features of the other 60%. So China will have a falling workforce, and the other 60% will have a rising workforce. On average, that puts them, even on that issue, way ahead of the developed world.
Stay out of trouble. Make sure you don't buy expensive markets, expensive stocks. Emphasize value, cheapness for what you get. Hunt around for the cheaper countries, hunt around for the cheaper stocks within those countries. Carry some cash reserves. There'll be perhaps some very nice buying opportunities. And whatever you do, get rid of this fear of missing out, this terrible lust to participate in profit making that comes along at the end of every one of the great bubbles. It is incredibly seductive, very hard to resist. And I would wish on most of you that you avoid it. Thank you. Bye-bye.
Click the link in the description and make a deposit to claim your free stocks.